Welcome everyone to the third quarter market recap from Schneider Downs Wealth Management Advisors. As always, my name is Jason Staley. I'm the Chief Investment Officer of the Wealth Management Group and a shareholder of the firm. With me is my colleague, Senior Investment Analyst Sean McCann, freshly back from his vacation to Hawaii and celebrating becoming an American citizen. So very exciting.
It's been an exciting couple of weeks. It has, yeah.
And so we'll be talking about an interesting topic to talk about with the newly minted American citizen has been the U.S. equity market that was surprisingly strong and not volatile at all in September.
Which is not historically how it goes.
Nobody had it on the bingo card.
Yep.
We're going to talk a little bit about the international markets and how they've really been powering returns. A strategy that we put in the portfolio almost 5 years ago that we think is pretty unique, and what I dubbed what I call a force multiplier in our portfolio. And then we're going to end with some thoughts on current valuations and kind of some things that we're both excited about and concerned about going into the fourth quarter. But we're going to start this market conversation or market commentary with a little bit of a rewind from an advisor meeting that we had as a firm. We get together once a week and talk about portfolios, financial planning, and things that are kind of top of mind for our advisors and our clients. And myself and a new partner in wealth management, Greg Daly, who runs our advisor team, I casually threw out a reference to the 1980s hit TV show Miami Vice. Greg responded, and we got into a very what I can only say is a very uplifting and very fun conversation about Sonny Crockett and Ricardo Tubbs. And so while the two of us are having this conversation,
just you two,
yes,
by the way, just you two.
Thank you, thank you for that. Great timing. We were having this conversation. It was great. We felt like everybody in the meeting was really taken with it. And then our younger colleagues, who have no idea who Sonny Crockett or Rico Tubbs are, have not only confirmed that they've not seen the TV show, they also did not see the movie that came out in 2006. Still haven't. And really cemented Greg and I as being kind of the old guys in the group, which if you read footnotes 1 and 2 in the commentary, you will find some truths in there from Greg and I's perspective. But I bring up the topic of Miami Vice because when we were in the advisor meeting and we were looking at asset class returns, this market looks a lot like the 1980s, where you have U.S. equities doing well, but international equities doing very well, kind of leading the way. And my reference to Miami Vice at the detriment to a bunch of old age jokes, which got progressively less funny. You looked at it, and it was the strength coming from really a wide array of non-U.S. companies, obviously countries outside of the U.S. And in the 80s, Japan was the dominant force. Everybody was worried about them eating the world. They were going to become the economic superpower that the U.S. had historically held kind of post-World War II. Obviously, a lot of things changed. We're going to talk about it. There's a chart, a really, really good chart in this market commentary that kind of shows how equity markets have ebbed and flowed over the last 40 years. But it was a great conversation. I certainly wish you guys could have been there. For those of us that still hold Miami Vice in high regard, I would just note that through the end of 9/30, international developed stocks were up 26, emerging market stocks were up 25, and a reboot of Miami Vice was announced in September to hit movie theaters in 2027. So what was once hip is now again, apparently. And to some. But I think it's a great way of thinking about the markets and thinking about how things come back together, because it really has been, the international markets have really, have been the leader in the clubhouse for 3 quarters in a row, and have built up a pretty good lead. That isn't to say that the U.S. equity markets haven't been good.
Oh no, I think it's been pretty strong across the board. especially when we talk about the third quarter, right? I think 2025 as a whole definitely has been international equities this year, right? They are the banner asset class for sure. Well, maybe the exception of gold, which we'll get to.
We're gonna get to the yellow metal.
Yeah, but U.S. equities, at least for the third quarter, pretty strong across the board. U.S. large caps up at about another 8%. You know, generalize the U.S. equity complex, at least in the large caps, is like, don't go against the grain, right? What worked in the third quarter, and that was large cap tech outperformed in the third quarter. But then when we move down the market cap, right, we look at mid caps, small caps actually outperformed their large cap counterparts, which, you know, we haven't seen over the long term, but it's a really good sign, I think, for things moving forward.
And not only did they outperform, right, the S&P 500 up 8%, nothing to sneeze at in the third quarter, up 8%. I think it was the fact that they outperformed them in a strong, historically strong third quarter.
Yep.
And what I can only say is a September that I don't think anybody expected, in terms of there being very little volatility.
Yeah, especially when September, right, historically speaking, is one of the toughest months of the year for U.S. equities. For U.S. small caps to outperform is another great sign. You know, really what's driving that outperformance is we actually saw pretty great earnings in the second quarter, especially in the small cap space. Again, valuations are coming into play again, where, you know, we think about the AI names in the U.S. large cap space, and things are really expensive. And so we got to think about where we can allocate capital, and small caps continue to be a spot in the portfolio where it's not overly expensive to be buying at this point. And so I think that was a driver of returns. And then the other big event I think that happened in the third quarter, right, was Federal Reserve cut interest rates by 25 basis points. And as we all know, right, small caps are highly levered to where interest rates are. And so interest rates coming down is a huge tailwind. We got some news in the fact that the Fed might be cutting one or two more times this year.
Yeah.
All strong tailwinds for the small cap asset class.
And I think that the economy continues to grow, right? I think we're likely to get a surprise. I would say a surprise print in that, the Atlanta Fed that tracks, the daily GDP growth, 3%?
Yeah, it got revised up, didn't it?
I think it got revised up.
Yeah.
So you're looking at it, and I think it's there are things shaping up in the U.S. equity complex. I think we feel better about the valuations in small and mid cap stocks, mostly because I think that the large cap stocks, right? They're starting to come at each other. It used to be that they were trains running in a parallel path with a bunch of revenue in front of it. Now there seems to be they're kind of beginning to fight over the same revenue.
Yeah, there's a lot of deals being made, a lot of promises being made, but right now there's not actual revenue being generated for a couple of companies there is, but not across the board. Like you said, they're all kind of competing in the same space.
And now NVIDIA has just this morning, Oracle's cloud. We're going to buy 50,000 AMD chips. So that used to be the domain of NVIDIA. So again, kind of competition in the US large cap market, pretty elevated valuations. Really good to see small caps, outperform in that environment, which kind of takes us back to international stocks. The strength of international stocks, I don't think, came as a surprise to our group, which because we have steadily maintained that we needed to own them. We probably had a larger allocation to international stocks than a lot of our peers, in part because we looked at the valuations, we looked at strong dividend yields, and we felt like fiscal and monetary policy that was going to end up being accretive to the stocks and GDP growth within the Eurozone, within Japan, kind of developed Asia. I think the one surprise within the international asset class weren't those factors. It was, I think we expected to have positive contributions. It's been the significant decline in the US dollar.
Yeah. I mean, I think if you look at the US dollar's decline and you just took that performance, I think that equates basically to the S&P 500 year to date.
Yeah, I think it's very, very close. And that has been the really big catalyst moving forward. And when you've seen regime changes where you've seen international stocks really outperform their US counterparts, it's almost always in a declining dollar.
Which we haven't seen for a while.
Which we haven't seen for almost a 15-year period.
Yeah.
We have seen the dollar decline, 13, 14%. Like you said, kind of equating, adding the equivalent of the S&P 500 return to international stocks. It's hard to see. It's not impossible to see the dollar begin to regain steam, but I think that the safe haven currency, that the U.S. dollar represented, we're gonna get to talk about the yellow metal here in a second, but kind of to predate. So the idea that the dollar's not getting bid up as much as the reserve currency as it maybe used to be, I think it's important to note that, like everything in life, like cycles, right? We talk about Miami Vice was the hit TV show in the 1980s. And then unfortunately for several generations, they don't get to witness what it's like to see Tubbs and Crockett run, with the top down on the convertible, descending upon South Beach, to preserve and protect the interests. Okay. But cycles, right? Things come back in cycles. And in 1987, the Japanese stock market accounted for over 40% of the market capitalization in the entire world. It was 40%. The US market was 30%. You fast forward 40 years later, the Japanese stock market is less than 5% of global market cap. US market, 65%.
Big change.
Big change. Things move in cycles. Nothing is ever permanent. Nothing is ever promised. And I think that as we think about cycles, I think it's a nice way to discuss the performance of gold, which I'm going to use historic. I don't think that's much hyperbole. A historic run.
Yeah, I mean, gold, typically speaking, is not an asset class that we talk about in an exciting manner most of the time.
Most of the time when gold is going up is for not a great reason.
This year, I think, is a bit different. Granted, there has been some geopolitical volatility, right? There's been some trade war concerns going on. And obviously, we've seen international kind of outperform, part of that flight to away from America. But, because of that geopolitical tension and some other heightened risks within the U.S., gold is performing really, really well, right? And on top of that, central banks, right? We've talked about getting away from the U.S. dollar. What we've seen across the world is central banks are also been buying gold, not just retail traders. And you kind of put those both together, and gold is up over 45%. I mean, I don't want to say it's crazy, but I mean, it's astonishing.
Well, and I think it's because you're not, I think it's astonishing in the fact that we don't typically associate all the major asset classes that we typically put in: U.S. large cap, equal weight S&P 500, small cap, international, emerging markets, real estate, taxable bonds, muni bonds, 3-month treasury bills. Everything is positive. And the best performing asset class is gold. So gold's going vertical at the same time all of these other asset classes are doing well. And I think that has been to, I think, astonishing is not again, not hyperbole. I think no one expected real assets like gold to be up 51% when the S&P 500 is up, almost 15% through 9/30. It's declined a little bit, in the fourth quarter, but I don't think anybody expected that.
Yeah, and I think a lot of times we talk about gold as a diversifier, and it still is. But like you had mentioned, right, gold typically tends to perform well in risk-off environments, which, granted, the first 4 months around April, we definitely saw gold outperform when we had a lot of trade tensions going on. But like you said, it's been a strong year for a lot of asset classes, and gold has not only kept up, but massively outperformed, which is not, how we historically see it, the asset class perform.
No, but I think that it's an important part in our portfolios.
Yeah.
We made a strategic decision to put a strategy in the portfolios about 5 years ago, maybe 5 or 6 years ago, has a dedicated allocation to gold that hovers around 15%. Roughly 10% of that is in kind of gold bullion, so the gold bricks, and then in gold mining stocks, so the companies that are involved in pulling the gold out of the ground. So that strategy has done very well. Did very well in 2022 again. A year where we would expect something like that
to do well.
Diversifier. Treasuries are down 13%. Stock markets are down anywhere between 18 to 30, and this one, that strategy performed very well, like you'd expect. But another very strong performer, right?
Yep.
And driven by gold. When you look out, Sean, I mean, there are things to both be kind of excited about going into the fourth quarter and things to be worried about, not the least of which is, I believe, at the time that I wrote the market commentary, we were on day 8 of the government shutdown. I think we're now on like day 13 or 14. Kind of getting longer. We keep going on that. That's certainly a reason for concern.
Yeah, ever since actually, funny enough, I became a citizen, the government has been shut down for most of that time.
Well, we're not gonna that I'm not gonna blame you for. We can our elected officials in Washington D.C. Kind of need to figure out a way, because I do think that that's something that if that goes on longer, that could have,
we'll see more impacts.
Yeah, significant impact, and really, obviously certainly worried about the people that impact, right? More so than markets. Hopefully we can get that figured out, get them government workers the back pay, and figure out a way moving forward. Elevated valuations. I mean, I think we saw some of that steam come out, on a Friday where leverage unwound in cryptocurrency land, where a lot of speculative aspects, and I think some of the AI trade, and kind of think about drones and some of the infrastructure around the drone trade and defense trade. Some of that unwound, but 3% declines in stock markets.
They happen.
It's I think probably more healthy for a market that's up like 30% off the lows.
Yeah, and you had said, right, September is typically a volatile month. We didn't see that. So I think having one volatile day last week is not the end of the world.
Yeah, I think the market gods might have just said, hey, we're going to give you one to keep you on your toes. And
yeah.
So, I certainly think interest rates staying elevated have caused certainly are still disrupting parts of the real estate market.
Yeah.
Although, Manhattan office real estate is the hottest market in the country right now. You're seeing rent rises go, significantly greater. We're bringing people back to the office. JP Morgan, Google, Blackstone, Goldman Sachs. A lot of these larger firms are bringing people back into the office.
Yep.
So that's certainly something. But the broader real estate market remains, I think, uneven depending on the region that you're in, and I think the labor market.
Yeah, we got some soft numbers, didn't we, this past quarter as it relates to jobs and the labor market, which I think is something that definitely, obviously, we're keeping an eye on. But I think more importantly, the Federal Reserve has definitely got an eye on as they think about future monetary policy and where that might go.
So with that, we're going to kind of wrap up, and I wrap up the letter with probably one of my favorite quotes from Miami Vice. I literally could not help myself. It's from Sonny Crockett. It says, "You just got to learn to go with the heat, Rico. You got to keep telling yourself, no matter how hot it gets, sooner or later, there's a cool breeze coming in." That's something that we think about a lot at Schneider Downs Wealth Management in terms of our client portfolios, the markets, and we understand there are parts of the market that feel expensive, that feel hot, and we are aware of them. We continue to monitor them, and we know ultimately our job is to navigate and get these portfolios so that when that cool breeze comes in, we're in a good spot. Like that's what we're trying to do. And I think while there are certainly going to be challenges in the fourth quarter, there always are. We're really excited about the way our portfolios have performed through 3 quarters. We're excited to see you guys in the coming weeks and months ahead, hopefully in person, if not in person, certainly over a Zoom or a Teams meeting to talk to you about the portfolio and things to come. But on behalf of Sean McCann and I, newly minted American citizen Sean McCann, we're very, very excited to deliver this third quarter commentary to you. So Sean, thank you very much.
Till the next one.
Appreciate it. Till the next one.